Hey, welcome back to the Business Emergency Room. I'm glad you're tuned in today. What I'm going to talk about is a somewhat harsh subject today, but I feel one that is not often enough discussed. And it's about trust or bust, why investors replace founders. Leadership today isn't just about scaling. It's about navigating constant uncertainty, market disruptions, and high-pressure decisions. If you're dealing with chaos, bottlenecks, and relentless pressure, welcome to the Business Emergency Room. The critical issue here is misalignment and miscommunication between business leaders and investors. It's a very common challenge and one that leads to a lot of businesses failing and a lot of frustrated investors, no doubt, too. I don't think any of them want to see their businesses fail or want to pull their money out, but see often that as the only viable solution. So why do I think this is such an important topic? Well, 94% of investors say that trust in leadership is key to their investment decisions, right? So 94%. So that's almost all. It's a major factor. Also, 50% of founder CEOs are replaced within 3 years of investment and often forcefully. So in 3 or 4 cases, those CEOs are worked out of the business by the investors. That's a huge number. On the flip side, companies that align well with investors raise 50% more funds, more capital, and also see a 2 times higher profitability growth, according to Bain & Company. So if you're feeling friction with your board or investors, and even if it seems normal or in the normal range for such a fast-paced environment where lots is happening, I think this is an issue that you shouldn't underestimate and should keep an eye on and should consider working before it escalates and results in lost funding or forced leadership changes. In my experience, neither side in this typically has a lot of patience and typically has a lot of appetite for change late in the game. So if these relationships start off on the wrong foot or deteriorate over a sudden change or issue or a business crisis, there is not a lot of time to fix things before it escalates and actually becomes irreparable. So why do leaders and investors clash so often? Because it is often. Well, at the surface level, the conflict is pretty easy to see, or the potential challenge and tension, right? Because leaders think, well, we built this, we know what's best, we're the ones who are operating this, so leave us to it. And the investors say, well, we funded this and we need to protect our investment. But deeper issues really are that this is about lack of trust and lack of transparency. So typically investors feel uninformed and leaders feel micromanaged. Also, I typically see lots of avoidance of tough conversations. So discussions are delayed around performance and leadership and governance changes. And because they're delayed, they are often held too late, meaning that people feel lied to, feel that they haven't been kept in the loop, or taking or drawing their own conclusions. And that is both ways. I also see investors not liking what they see in the leadership team and thinking that giving the team space to show what they're made of too long, whilst they're watching them do more of what they don't like, their frustration with the team builds up. And then by the time they bring the issue up, there is often no time for the leadership to course correct based on the feedback. So both sides typically are not very good at having the tough conversations and breaching the tough subjects. There's often also mismatched reporting expectations. So leaders assume results speak for themselves, or that the reports that were generated previously or for others are also effective for the current suite of investors. And And investors want structured updates, different updates, more updates, etc. I also often see conflicting priorities. And although I think there will always be a certain level of conflicting priorities, if priorities truly are misaligned and the main priorities are at conflict with each other, that's never going to work. I often see that the leadership is really focused on long term and tend to sometimes feel overtly safe now that a new investor is on board saying, good, we're now good to go. Let's go and roll out all these long-term plans that we didn't have money for, while investors are still looking for short-term returns. At its core, this whole challenge is fed by strategic risk management issues and really around change from previous phases. So investor expectations evolve, and there is really quite a difference because early stage investors prioritize growth and market potential with the leaders. But if you get to a pre-IPO stage, then profitability and structured governance and financial discipline is really important to make the hurdles to get to next stages and to ensure long-term value. Also, the need for control and reporting increases. So there is typically a lot less autonomy for the leaders in the business. As companies scale, investor oversight grows. They require more structured decision making and decision hygiene in your business, which of course I believe totally in too. But expecting that and wanting that versus that also happening and or allowing and creating space for it to be implemented when it didn't exist in that level or of granularity and form before clashes sometimes. There's also typically a change to much more formal board governance. There is many more people involved in the company that the leadership doesn't have personal relationships with. And so more detailed financial transparency is also important because there is no personal relationship, but also to prepare for public markets in many cases. Leadership must scale too, and founders may need to bring in or feel the need to bring in differently experienced executives and adjust leadership roles, or even, step aside as investors or push for as investors, and they push for a proven team of capable people and individuals that are able to manage large scale operations and their expectations. And so not only do you run the risk as a leader in a business in those kind of transitions to be pushed out due to misalignment with the investor, you have to understand that if you are really scaling significantly, that the investors are already typically coming in with looking at you differently, right? You're already being evaluated differently because people are wondering, if you've been there from the start, are you the person that has what it takes to take it to the next step? As I just said, it's 94% of investors. For 94% of investors, leadership capability is a huge factor in making investment decisions. So, and it's clear from all the feedback and all the experience that I see with businesses going through this, that yes, they've made an assessment before they put their money down, but it doesn't mean that they're done evaluating the leadership and that they're done, that they will stop. They will continue to look at you and look at your performance as a leader and say, was my original assessment correct? Is this person still the one who I believe can take it to the next phase? So whether you are going into a new relationship, or whether there's just been significant change, or whether the relationship has just gotten a little trickier because of some things you all went through together. There are, of course, ways to fix these relationships, and that's what I want to talk about now. So what are the things that you can do if you're sitting on the business side, so as a leader inside the business, to fix the relationship or improve the relationship with your investors? or set it up right from the start. The first thing would be to define your investors' needs early. What are the risks that they see? What are the decisions that they are trying to make? What are the priorities they have? And what are their expectations? And have a dialogue about that, right? But because if somebody expects all of it, it's also not reasonable that all of it happens. I love to talk or force my stakeholders into a conversation around must-haves and nice-to-haves, because typically people want a lot. But that doesn't mean that we can get it all, right? So you want to know everything they would want, because ideally you would satisfy all their needs for a perfect relationship and to build trust with them as soon as possible. So then understanding in everything they want, what are some of their really must-have items that for them are difficult to go without, and which ones are maybe more on a nice-to-have list. And maybe you can buy a bit of time and say, I will try and get those to you with regularity, or maybe at a slightly lesser frequency. At the same time, if this is a new relationship, or there has been a significant change or a breach of trust, there may also be temporary needs, and it will be really helpful to be transparent about it and find out about that. So if there's been an incident, I don't know, I had a client who was under investigation by the SEC. Well, I can assure you that all the investors for a good while wanted a lot of additional reporting and a lot of additional information, but it was clearly attached to that issue. You can have an issue at a much smaller level and still need to temporarily to rebuild the trust, provide additional reporting. Your frustration as a leader in providing so much additional information and having so much additional oversight will be lessened if you know that it's of a temporary nature, especially since you expect that you can fix the challenge and hence rebuild that trust, right? So the better you do, the quicker you will rebuild the trust, and then that can go off the plate. So defining what your investor really needs. Then you want a cadence. You want clear agreement on how often some of this information is shared and how often you communicate and what the standard protocols are. And in that, you again can have a conversation and try to get things to a reasonable or doable level, because you also have a business to run. If your investor is asking for information in format A and you provide 90% of that, but in format B, then have that conversation. Show them what you're already generating. So it's also in their interest for you to not run too much specialized reporting for them, because then it's always going to be a little late. It might not be natural to pull some of that data out of your systems. They need to understand if that's a lot of work, because that's not necessarily helpful to create more work for anybody in this. And if they get data that you're also actively monitoring and using and looking at in a format that you're using it, that's helpful for them to understand and to look at it in the same format. So have the conversation about the cadence, about the frequency, about the format, and about the channels that you use, and make sure that there is enough face-to-face time in there, or time that allows for real, true two-way conversation, for clarifying questions, and not an over the fence, here is my report. Now the investor is going to look at it in isolation and assume a whole lot of things, and maybe only ask questions about some of it. So you want to make sure as a leader that once you provided the reports and the data, that the investors also understood what they looked at, or has a similar understanding of what the data shows. And if you don't, that you can have that conversation. Which brings me to 3, you need to agree on escalation protocols. And escalation protocols are needed for when there's discrepancies, when key personnel are not available. So when you're supposed to communicate every quarter, investor isn't there. You still want that contact and not make it suddenly 6 months before you meet again. You don't want that quiet. The investor also wants to know that if something special happens, that you're not going to wait till the next time you meet. So what are the things that are deemed special? What are the things that your investor would want to know about? Knowing about it and immediately then telling you what to do about it are not the same things, right? If an investor finds out about stuff happening in your business that they really should know about through another employee or a friend, or reading it in the paper or reading it in a market report, that's bad. Yeah. They need to know what the big things that happen and that and even if it's you just flagging that it's happening and saying we've got it in hand and we're working the issue, you need to have those conversations. So agree what needs escalating, how, when, and why. Then you need to take investor feedback seriously. So that's, to me, point number 4, and the one that I see go wrong very frequently. I do think that this is especially a challenge with people who really come out of that startup phase or who had funding from close sources. Yeah. If you then really make that switch to funding from sources that are not in close relationship or are there is also huge variation in investors, and there are definitely investors who are quite hands off. If you're funded by a huge fund that is well spread and well risk managed, then the investment in your business to them might not be such a huge deal, and you might still have held on to autonomy a longer time. But at some point, you're going to get your first investors that are going to be quite hands-on because of the size or the scale or the risk or whatever it is. And typically the first time that happens, there is a struggle with the feedback from investors. But you have to appreciate that these are professionals who have done this before, who are doing this all the time, who get to have a look in many kitchens. And even if they don't necessarily have your type of relevant industry experience, or even if they don't have operational experience in your type of business, they are a fresh pair of eyes. They know enough about your business to have been willing to put money into it. And they have some ideas. They also might just be trying to give you feedback on the way you deal with them or communicate with them. And ignoring that or not listening to that is going to erode the trust relationship very quickly. It doesn't mean that you need to take every and all piece of feedback on board. And we all know that there's definitely feedback that really is just criticism. It's unsolicited and it's just criticism. But criticism from an investor is ultimately also something that you don't want to negate because it's a signal of something else. And so if you get feedback that's weird or odd or doesn't sound right, you need to do something with it. There will and may be very well some really good nuggets of advice and information in there. And then there is stuff in the middle that is really an invitation to have a conversation about a subject a bit more in depth and understand how both of you are looking at the situation, right? It's an opportunity to get to greater alignment and to build more of a relationship. So take the feedback, use it as a conversation starter, and don't just dismiss it or say thank you and then never get back to any of it. That may work with your boss in a work relationship at lower levels, or it may work in the school environment. That doesn't work when these people are funding your business and can make decisions whether you hold your job or not. And then last but not least, you should be proactive, not reactive. Yeah. So as I started the podcast, I said you might feel that there is some friction between leadership and investors. And many people I work with also say, well, that's natural, right? It's natural that we're not all wanting the same things. We don't all have the same priorities. The business is changing very fast. We've all been successful in our own right. So there's also lots of egos involved. True. All of it's true. That doesn't mean that that you cannot strive to make that relationship healthier, or at least check that the other side also feels that the level of tension that does exist is in the range of helpful tension, helpful banter, um, something that doesn't disturb the collaboration or doesn't act or isn't actually and on their side kind of a slow build up bucket of marks against your name, or on how you're performing and their trust in you. So you want to have the difficult conversations. You want to have structured discussions around difficult topics, and avoiding them is not going to do anybody any good, because it's effectively stalling critical decision making. And these issues don't go away by doing nothing about it. And if investors feel ignored, then tension builds. And over time, that becomes unfixable actually very quickly. As I said, there's not a lot of patience typically on either side to fix something that's been a buildup of annoyance and irritation. Which brings me to, what is it that investors can do to improve alignment? If you're an investor, this is for you. But as a business leader, I think this is also something that you can articulate with your investors or ask for in some way, shape, or form. So you want your investors to help you by clearly articulating their expectations up front, and what are these must-have and their flexibilities. You want them to be open to accepting some of the existing business processes instead of forcing unnecessary change. You also want them to recognize that governance processes take time. If you are in a fast changing and fast growing business, you are, particularly in the early days, perpetually behind on terms of governance processes, right? And yes, it's also typically not anything anybody wants to work on, and most businesses should implement them faster and quicker than they want. But you cannot want something to magically start existing overnight. And it takes time to implement governance processes and to get used to it. And if you're starting to collect data or measure data or generate reports, it takes a little bit of baselining and data development before any of it is meaningful. And I've seen so many teams argue and boards argue about numbers that really only had a timeline of 3 months, right? So 3 months data had been collected. There was no clear baseline. There were some extreme events in those 3 months. You can have humongous debates about what that data means, but you're actually more helped by saying, we don't actually know what it means. So how do we get faster, better data? And what can we do to get there? And in terms of governance, if you need to get a better governance structure in your organization faster, the quickest way to do that is actually bring in somebody to help you do that. Because otherwise it will be forever somebody's stepchild, and it gets as much time as somebody is willing to spend on it. And you're going to forever stay behind the eight ball. So you need, if you are in a high risk space and you need that governance, then you need to invest in having it put in place. You can also, with your investors, work on a shared strategic risk register. To me, that's key. And it's a very good tool to get to alignment and to have the conversations that will help you get to mutual understanding how both parties see these risks. Typically, I don't see a lot of misalignment about what the main risks are to the business. I do see some misalignment, which I don't necessarily think is misalignment. I see some difference in opinion or different perspectives on how high the likelihood of occurrence of these risks and or the impact that may have, right? So an investor, the joint agreement might be that the risk is around losing key resources for them being poached, or for instance, or a competitor getting to market faster, things like that. And typically an investor, as an outsider, is less emotionally involved in the business and hence has a different opinion on that than somebody who operates in that space on a day-to-day basis, of course. And that's okay. To me, that's okay and can be very functional, as long as you both agree that that risk exists and that you can both appreciate from each other that you don't entirely see it the same, because neither of you is going to be right. And the truth is going to be somewhere in the middle, or is going to be more towards the investor side or towards the leader side for different risks. It's more about the fact that these conversations happen, that these things are on your radar, that they're monitored jointly, and that you continue to have conversations about these subjects. So, trying to bring all this to a close, misalignment between leadership and investors is extremely common, but too few companies and too few of those pairings take the time to set up the relationship for success and to take the time to refresh or better that relationship after some major things happened. But like any partnership, it requires work, it requires communication, it requires transparency to avoid unnecessary breakdowns and to have that trust that leads to an effective collaboration and partnership. So don't let minor tensions spiral into lost funding or forced leadership changes. And if you need a strategic session to align leadership and investors, if you want some facilitation there, let's talk. I can help facilitate those real discussions to keep your business on track and to keep all parties happy and not irritated, and ensure that the irritation doesn't build up because both sides have the right tools to engage with each other. Yeah, I think this needs work in any and all business. So please reach out if you want help. Have a think about what you can do to better your relationship in this space. And I'm sure we'll circle back to this topic in a future episode. I'm glad you tuned in today and look forward to having you here next time. Thank you very much. Thanks for tuning in to the Business Emergency Room. If today's episode hit home, let me know. Leave a review and tell me what challenges you're facing. Your feedback helps shape future episodes. So drop a comment or a message on LinkedIn with what's keeping you up at night.